Hey, welcome back. So this is going to be our first section where we're going to talk about the stock market so that you really understand what it is, how it works. So this is time to learn the basics. So what are stocks? Very simple question. So it should have a very simple answer, and it does. Stocks, also known as shares or equity or assets in the market, are financial instruments that represent partial ownership in a company. When you buy a stock, you essentially become a partial owner in that company. So something to consider is that all of these stocks are going to be influenced by perceived value among the investors. So a stock is only worth what we all agree to pay for it. And if we all suddenly say it's not worth that number as investors, then the price will either go down or up, depending on what we're saying. Maybe we're saying that it's not worth that because it's worth more. And if it's worth more, then we're going to be buying it, and everybody's going to be buying it until price starts to reach that equilibrium at the price that we all perceive it to be worth. So just something to consider. So what is the stock market? So if a stock is a partial ownership in a single company, the stock market is a collection of thousands of companies that all trade on exchanges where investors try to find that equilibrium of what the stock price is actually worth. So we use benchmarks like the S&P 500, the NASDAQ 100, the Russell 2000, and the Dow 30 to gauge the performance of different segments of the market. So each of these index has its own methodology and its own uses, and we're going to talk about that. So the S&P 500 is going to represent the 500 largest U.S. companies. They covering various industries. So something to note about all of these is that they all will contain stocks from different industries or different sectors, but they all also represent different segments of the market. So they might carry different sectors, might be in financials and information technology, consumer discretionary, industrials, energy, etc. They might have a collection of stocks from all of those different areas, but they put them in one basket to say that this average of the market or of this section of the market has X amount of value. And we look at those different sections of the market to try to figure out where the money is going. Each and every day, you might find the money is going to one specific sector versus another. And you might find that that sector has a heavier weighting in one of these index. For example, the S&P 500 is a more broad basket of stocks in the market. But there's still 500 of the best stocks, from all different sectors in the market. Versus the NASDAQ 100, which is just 100 of the largest non-financial companies listed on the NASDAQ exchange. So the NASDAQ is more information technology weighted. There's a lot more stocks that have, tech style stocks in the NASDAQ. So one day you might find that financials are doing really well. Well, you probably wouldn't expect the NASDAQ to be performing because these are non-financial companies. But on another day, you might find that stocks like Apple and Microsoft and Amazon, Nvidia are all doing really well. This is probably going to be a day where you'll find that the NASDAQ is outperforming the S&P. Also, on the right-hand side, we have the Russell 2000. This is going to be focused on the smaller cap, mostly the stocks that say have less than a couple $1 billion market cap versus a company, say like Apple, that has a $2 trillion market cap. So the Russell is all the little small companies. Personally, I don't really trade a lot of stocks in the Russell. Occasionally I do. Occasionally they really they get a lot of volume. They get a very strong trend, and they catch my attention. They catch our strategy's attention. And we really, for our strategy, want to be trading stocks that are highly liquid. Really, when you're trading at all, I highly recommend you trade very liquid stocks. It's just easier to get in and out of your trades. And that can be more difficult on stocks in the Russell. Also, stocks in the Russell are, I wouldn't say they don't have weeklies, but there are more stocks in the S&P by percentage that have weekly options, and there are stocks in the Russell with weekly options. I believe that's a fair assessment. So really the Russell is just not really where I focus most of the time. There are some small caps that do stand out, but those are exceptions. But most of the time I'm focused on, how is the S&P 500 doing? How is the NASDAQ 100 doing? The Dow Jones 30 is also a very respected average. Many people follow the Dow. Many people consider it to be a great average. Personally, I don't. It's only 30 stocks. Keep in mind a stock like Apple, which is in the Dow with a 2 trillion market cap, versus a stock like Boeing, which only has, I don't know off the top of my head, but I would say a couple hundred billion market cap. When Apple does really well, the Dow can have a significant move. But when a stock like Boeing does really well, maybe the Dow doesn't move so much. So in my opinion, the Dow is too influenced by those larger market cap stocks that it's composed of. These smaller stocks simply just don't have enough weight to move it in the same way. So this average can be drastically influenced by just say one or two of its assets, like Apple or Microsoft. So something else to note about index is index cannot be bought or sold. There are no shares on the index. These are simply a reflection of these 500 stocks or of these 100 or 2,000. And it's just a reflection of what all of these stocks in the basket would be worth. But these index are put into exchange traded funds. These exchange traded funds are your way to invest in these markets, in these averages. And when we talk about the market, when most people talk about the market, they're usually talking about the S&P 500. It offers the best average of those 500 best stocks in the market. So most people, when they're investing in the market, they like to try to buy the SPY. SPY is the ETF for the S&P 500. When you're looking to invest in the NASDAQ 100, maybe want to be a little bit more aggressive. You understand that those information technology, the technology FANG stocks, nowadays they call them the Magnificent Seven stocks. They're more heavily weighted in the QQQ, and maybe you want to be a little bit more aggressive with your portfolio. Instead of being in the basket of 500, you kind of want to be in the best 100 stocks. So that's what I would say is in the QQQ. And that's where you would want to invest your money if you wanted to be a little bit more aggressive with your market investment. And again, if you want to invest in those small cap companies, which can have tremendous upside, you might want to invest in the Russell. Again, I'm not a huge trader of the Russell. Some of those small caps do eventually stand out to me, and then I start trading them. But I'm not a huge fan of trading small cap stocks with low volume, without weekly options especially. And again, we have the DIA, which is the Dow 30. A lot of people like to invest in the Dow, so this is your way to do that. But again, it's going to be more heavily impacted by individual assets in its portfolio, say like Apple or Amazon or Google, that might drastically influence its price. And I'm not actually sure if Google is in the Dow. I know Apple for sure is. So that's my greatest example anyway. Apple is a $2 trillion market cap, or greater than $2 trillion market cap these days. And when you compare that kind of number to one of the smaller companies out there, just off the top of my head, a company like Riot. Riot is a Bitcoin miner company, I believe, that has a market cap right around $1 billion. $1 billion versus $2 trillion is a grain of sand. And that company, it can have the best day ever. Literally, you can go up 1,000%. And even if it was in the S&P 500, you probably wouldn't feel it, because it's not enough market capitalization, it's not enough weight and money to affect that kind of average. So just something to keep in mind. The larger the market cap, the more influence a stock will have on these averages. But of course, it has to be in one of these averages. So Apple does not affect the Russell. Apple is not in the Russell, so Apple could have the best day of its life and go up 1,000%, and the Russell wouldn't do anything. It wouldn't reflect it at all. So something to keep in mind as well. So yeah, the exchange trade funds are popular investment vehicles. They offer several advantages. They have diverse holdings. They're holding all of those different assets from that fund. S&P has 500, NASDAQ has 100, Russell has 2,000, the Dow has 30. So it gives you a bit of a diversified portfolio by only investing in one thing. You don't have to pick the basket. You let the institutional traders who make the S&P 500, make the NASDAQ 100, make the Russell 2000, you let them pick all of the best stocks, and then you just stay focused on that single index because it tracks all of those best stocks. And if they perform well, the index performs well, and your investment does well. So another thing about all of these is they are heavily traded, especially SPY and QQQ, I can speak to as being two of the most heavily traded assets in the market each and every single day. I just took a screenshot of the option chain on SPY, for example, and on the call side on Friday, the options I was looking at all down the board had hundreds and hundreds of thousands of options traded, and there was tens of millions of shares traded. So lots of trading going on in these ETFs, meaning they're highly liquid. They're very easy to find a buyer for your trade, find a seller for your trade. So if you want to get in or get out, there's somebody there waiting at fair market value. And that's a very important distinction to make. Fair market value. You might be trading something with very, very low volume, completely opposite of SPY and QQQ. And you might find that since it has low volume, you're going to have a wide bid and ask price. What they want to offer you is significantly different than what you want. And to meet in the middle is a wide range of prices. So we're going to talk a lot about bid and ask and that wide range and how we can find the best stocks to trade, find the best deals, to make the best deals in the market in the next section. But for now, just want something to be thinking on is the more people trading the same thing as you, the easier it is for you to get in and out of your trade. And that's really important when you're trying to buy at a good price or sell at a good price, right? Another thing about these ETFs is they're highly transparent with all of their holdings updated every single day. So yeah. Now, when we talk about trading in the market, trading simply refers to the buying and selling of these financial instruments. Now, there are many types of instruments. We can trade stocks, one of the many companies in our ETFs. We could trade the ETF, which is a basket of all of those companies. We can trade bonds, we can trade commodities, currencies, and derivatives. Derivatives are going to be options and futures. These are the things that are going to give you the right to own, or the right to, I shouldn't say own, the right to buy or the right to sell one of these assets. So we'll get a little bit more into that later. But it's also important that right now you're already thinking about what kind of trading style you might use. How much time do you have to look at the market each day? What are your trading goals? Okay, if you want to be looking at the market all day long, collecting income from the market, waiting for these opportunities, day trading is really a great way to do that. Day trading, you're in and out inside the day. So your only goal is to put your money to work and pull it out when it's done working inside the day. Every day you go to work. If there's profitable opportunity, you take those trades, lock in your profit, and you get out. Swing trading is a little bit different. Swing trades must last at least one day. You buy it at market close, and you sell the next morning. You buy at market close, you sell the next afternoon, or maybe 2 days from now, maybe 5, maybe a week, maybe a month, multiple months. Typically, swing trades don't last much more than multiple months. That's a very, very good trade in general. And once you start going further than that, you start thinking about you're investing in an asset. You're buying to hold for an extended period of time. You don't want to pay capital gains on your income this year. Maybe you want to hold it at least through next year. So investing is a great way to store your wealth, to grow it in the future. For example, the S&P 500 on average over say 20 or 30 years performs about 9% or returns, excuse me, about 9% per year on your money. So if you just think about the target for inflation is 2%, and when we achieve that 2% number, if you're making 9% on your money, then you're actually effectively beating inflation by 7% per year, growing your money faster than your money is losing value. So investing is a really great way to store your money, but it's really important to lock in your profit. You know how to invest effectively. Just because you want to buy and hold, especially something like the S&P 500, which trends up over time. The S&P 500 still experiences corrections, so it's important that after your investment has done really well, to take some profit so that when a correction occurs, which they always do, that you'll have reserve capital to buy back in at that lower price so that you can do it all over again. And that's really what successful trading, successful investing is about. It's about consistently putting that money to work, growing it, taking it out, and then doing it again so that you can get those exponential returns over time. So ultimately, regardless of what method you're trying to do, I guess I brushed over scalping here. Scalping, I put it last because it's not really a strategy that I like. Scalping tends to be you have a strong expectation of what, say, the next one, maybe two candles are going to do. And you get in to get out just because price is going to, say, pop or drop on one or two candles. The problem I have with scalping is that it causes traders to fight direction. People who scalp like to try to call tops and bottoms, whereas with our momentum-based strategy, we just try to flow with the wave. It's like surfing. You wait for the wave to come in. When it's a good wave, you start to paddle, get up, you ride, and when the wave is over, you bail out and you wait for the next wave. Scalpers, they try to just get in, hop up, they say they're standing, and they jump down. And as long as they got standing, then it was a good surf. But I like to surf for the whole wave. I want to be on the wave as long as I can. And especially if it's a great wave, right? So you don't want to just bail out the second you get standing on the board. The goal is you ride the wave and you enjoy surfing as much as you can. You don't cause it to be this constant fight just to stand up. Standing up is only part of surfing. Riding the board, flowing along the wave is the fun part, right? So that's really why I don't like scalping. I like to ride the wave. I like to be a part of the trend and not try to fight the trend. Scalping is definitely a lot more hectic trading style. You're constantly trying to anticipate what's going to happen next, and you always have this feeling that I have to be right. And when you're really flowing with the momentum, it's not about having to be right. It's just letting time work out in your favor, because the momentum is carrying price in that direction. And the lower time frame you go to get in on that trade, the more likely it's going to work out. If you just sit on your hands and let things work, you ride that wave, as long as it takes to get to your target, to get to your destination. So a little bit on options basics. So options, I mentioned, they're financial derivatives. And what this means is they're not actually assets. It's not actual ownership of the company you're investing in. It gives you the right to be a buyer of that company or the right to be a seller in that company. Not actually a buyer, not actually a seller, but the right to do that. Now, there's two types. We have put options. A put option gives you the right to sell, and we have a call option, which is going to give you the right to buy. Now, on Friday of this week, the S&P 500 closed above the 5,000 level. So on the SPY, that's 500. The SPY is about 1/10 in price of the index. So SPY closed above the 500 mark. So we could buy a put, which gives us the right to sell at 500. Now, let's say this coming week, markets fall $50. Markets fall $50, we have the right to sell at 500, but now price is 450. Well, the right to sell at 500 way up here increased in value. Therefore, our put increased in value significantly. So doesn't matter that price had already fell because it's a contract. Somebody sold you the right to sell them shares at that price. That was the contract that they signed into effect by selling it to you. The seller is obligated, but you, the buyer, have the right. You have the right, but not the obligation. Now, why is that? Well, if you bought that $500 put, price rises $50 this week. Well, you might have the right to sell at 500, but price is at 550. Why would you want to sell at 500 if price is 550? That's like $50 lower than where price is. You're really kind of getting a bad deal there. So at that point, you wouldn't want to do that. You might have the right, but you're not going to use that right because it's a bad deal, right? So since it's a bad deal, we don't do it, and we understand that that option is worthless. Price is $50 higher than where we're actually allowed to sell. There's no deal to be made there. That's a bad deal. Forget about it, right? So at that point, the option will go to zero because it has no value. There's no point in making that trade. Now, on the opposite side, we have call options. A call option gives the buyer gives the holder of the option the right to buy shares on that company. Now, on SPY, the ETF, if we're holding a call option and price drops $50, the right to buy at 500 really kind of sucks. We want to be buying at 450 because it's $50 lower a share. It's much better deal. So at this point, with that call, we're going to let it go to zero, or it's going to zero. We're not going to let it. With our strategy, the goal is to never let anything go to zero. Our goal is to get in and out. But for the sake of this argument, in this case, if price is $50 lower than where you're allowed to buy, why wouldn't you just buy $50 lower and forget about your contract? And the answer is you would. Of course you would. Now, if price goes up $50 and you still have the right to buy at 500, now price is at 550. Well, of course you want to buy at 500 because you can immediately sell it for 550. That's a really good deal for you. So call options are going to make money if price goes up, and put options are going to make money if price goes down. And if either of these options are out of the money, not useful at expiration, they will go to zero because you wouldn't want to do that deal. So the reason we trade options is all about their leverage. Each option is going to control 100 shares of the underlying equity, whatever we're talking about. So just then I was talking about SPY. SPY $500 call gives you the right to buy 100 shares of SPY at $500, okay? Now, like I said, with these options, it's really important to understand how they can amplify both your gains and your potential losses. Now, if we're buying SPY, let me not jump too far ahead. So it's important to understand how to manage your risk with options and understand the risk of options. Options can go to zero in value. It's important to understand options have an expiration date. They must be used by the date, their expiration date, or they cannot be used. It's a contract to be done by this day, and if it's not done by this day, then we don't have a deal, right? So just like any contract you might ever write, you sign the date of when the contract goes into effect, and if the deal isn't done on that day, then there's no deal. So this is how options work too. They have an expiration date, and if you don't make the deal by that date, then the contract is null and void. We forget about it. All options reference a underlying asset. So I'm talking about SPY in that previous slide. So my SPY $500 call means that I can buy 100 shares at $500 of SPY. Okay. And also, it's really important that you note that option prices can significantly be affected by news, by earnings, by economic factors, by the VIX itself. the volatility index. So sometimes, especially say around earnings, your favorite stock, you might trade it every single week of the year, pretty much every single week of the year, and you might find that the options, the at the money options, and if this is getting ahead of you, don't worry, we'll get into it more later about options. But you might find that the at the money options are regularly around $200, but now it's earnings week, and you're noticing that the same options that you normally trade for about $200 are $400. So this means that price is expected to move probably about 2 times more than normal. And if it doesn't move 2 times more than normal, that option will lose that speculative value, the value that says that price is probably going to go twice as far as normal. If it doesn't, if it only goes the normal amount, all of that extra value that was priced into the option is immediately sucked out. So if you're buying these options that are overvalued and something spectacular does not happen, those options will lose value very quickly, making it very difficult to overcome your risk to time. Because again, every option must be used by expiration, or it must be used by expiration, and it must be in the money, a usable option at expiration to have any value. So if you're holding a $500 call on SPY and price is at $450, it's not very useful at expiration, right? So if your option is out of the money at expiration at a number that is of no value to exercise the contract, then the option will go to zero. And if your option was more heavily or overinflated in value when you bought it, the chances of that happening are greater. Okay? So, like I said, options allow you to control 100 shares of that underlying equity. And due to the fact that they're significantly cheaper than buying the stock outright, you can actually get significantly greater percentage returns compared to investing in the stock. For example, suppose a stock is trading at $100 per share, and you can buy a call option with a strike price of 100, meaning you can buy the stock at $100 for $5 per share. So this is a $500 call that gives you the right to buy 100 shares at $100. Now, if you had just bought the shares, keep in mind, it's only $500 to control 100 shares at $100. But if you wanted to buy the shares at $100, 100 of them, it would cost you $10,000. So it's significantly greater investment. And if you expect to price on that asset to move, let's say $10 in the next day, now it would cost you $10,000 to make a $1,000 profit on those shares. But using the options, you could actually make a $1,500 profit only using $500. So the option holder had their option increase from 5 to 15 in value per share, which is a 200% return, whereas the stockholder only had a 10% return. They took 100 shares from 100 to 110 versus an option from 5 to 15. So a significantly greater return trading the options. But keep in mind, the option had the ability to go to zero, whereas the shares actually gave the holder ownership of the company. Just something to keep in mind, because options only have value at expiration if they're exercisable, if you can actually buy the shares and it's a good deal for you to do that as the investor. So that's it for this section. In the next section, we're going to talk about market makers. We're going to talk about the bid ask. We're going to talk about market orders and the different types of orders that we can do. So I'll see you all in that video. All right.